There are lots of different types of mortgages out there, and often our clients are questioning which one is right for them. So today we'll be going through all the different options so that you can find the right one for you. Hello, welcome back to our channel and podcast. My name is Gemma, and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Ifti joining us. And for those of you who don't know Ifti is a trained accountant and mortgage advisor who has been in the industry for over 11 years. And he is also one of the founding directors here at WIS. Welcome back, Ifti. How are you doing today?
Hi, I'm very well, thank you. How are you, Gemma?
I'm very good, thank you. Today we are going to be covering all the different types of mortgages available. Now, there's actually quite a few, isn't there?
Yeah, there is. There is quite a few types of mortgages. Lately, we've been getting a lot of questions about the different types of mortgages because interest rates have gone up quite a lot in the last few weeks. So therefore, people are looking at various options. So we are getting a lot of questions around this. So I think this video will be useful for people who are interested in the different types of mortgages around. Yeah.
What are the different types of mortgages available?
So mainly there's only two types of mortgages, right? I mean, there are like some categories of some of these, but mainly there's only two. One is a fixed mortgage and the other one is a variable mortgage. So a fixed mortgage is fixed, right? So for example, if a client comes, take a 25-year mortgage and they say, I want a deal, right? So they will sign up for a 2-year, 3-year, 5-year. Nowadays you have 7-10-year deals as well, right? So when you sign up for those deals, you get a mortgage for that particular time period, which is fixed, right? So the key elements to this is that you will know how much you'll pay during that term. So if it's a 2-year deal, you will know exactly how much you're going to be paying every month, right? So that is a fixed rate mortgage. So if the bank says, okay, the rate is fixed at 3% and your rate is, you're paying £1,000 a month, so that's going to be for the term of the deal term. That's the 2, the 3 or the 5 years, right? That's a fixed rate. But the variable, on the other hand, is slightly different. You still have a deal, which is like a 2-year or 5-year, the term, but the rate will vary, right? So the rate is generally attached to something else, right? It's not fixed. You have trackers, like, the discounted rates, and there are so many other types of mortgages. It is linked to sort of some other rate, like a Bank of England rate or the bank's rate. So it's connected to some kind of rate, right? So that is a variable rate. So that you don't know, right? So you might start off paying £1,000 a month. By the time you finish, you might be paying £1,200 a month, or you might be even paying £900 because interest rates have got better and you've got a better deal, right? So meaning, it worked out better during the term, right? So that's a variable mortgage. So those are the two main types of mortgages. But obviously there are subcategories under these mainly, yeah.
So then what would be, if we start with fixed rate mortgages, let's talk about the benefits of a fixed rate.
For a lot of people, it's just peace of mind, right? It helps you with budgeting, right? So for example, like I said, if you know you're going to pay £1,000 a month for the next 2 years or 5 years, you will be paying 1,000. So it's easy for you to budget because for the mortgage, you need £1,000. So that's the biggest benefit you find with a fixed rate mortgages, because you know how much you're going to pay at the end of the month. But obviously, it comes at a cost, right? Because when you fix a mortgage, your mortgage is fixed, and if the interest rate goes down, you lose out because, obviously you don't get the benefit of that. Obviously, if the rates go up, you're laughing because obviously you fixed yourself for a deal, right? The best time to get a fixed rate mortgage is when interest rates are actually going up, right? So usually people fix their mortgages, they take fixed mortgages when they think the interest rates are going up. So that's mainly the benefit because it mainly helps you with the budgets, right? But obviously there are some downsides to fixed mortgages as well, because most of the fixed mortgages has an early repayment charge, which means, let's say you took a 5-year deal, 3 years down the line, you have to move house, you may have to break the mortgage and pay a penalty. So that's a disbenefit you have with a fixed rate mortgage. And obviously, if the interest rates go down, you lose out, right? So you get those disbenefits as well. But if somebody is looking for peace of mind, budgeting purposes, and maybe in climates where they're really expecting the interest rates to shoot up, maybe fixed rate might be a good one.
If we're talking about variable mortgages, what are the main types that we have available?
Yeah, the most popular one is a tracker, right? A lot of people think variable rates are just the tracker, right? So if you say, okay, are you interested in a variable rate? A lot of clients turn around and say, are you talking about a tracker, right? So tracker is the most popular one. Tracker tracks, like I said, variable rates are generally attached to something, right? A tracker mortgage is attached to the Bank of England base rate, right? So as of today, the Bank of England base rate is 1.25%, right? Obviously, there's a lot of talk that it may change, but as of today, it's 1.25%, right? So if somebody is paying 1% above Bank of England base rate, that's the deal you've signed up for. So it is 2.25%. That's what you will be paying, right? But tomorrow, if the Bank of England decides, okay, we're going to increase our rates from 1.25% to 1.5%, your interest rate, which is attached to the Bank of England base rate, also goes up by 0.25%, which means you're paying 2.5%, right? So that's how it works with a tracker. So the trackers are generally connected to the Bank of England base rate. But there are sort of, some advantages in this sort of products as well, right? Yeah.
Before we get on to the advantages, let's just go through the rest of them. So the next one we've got is a discount mortgage. What's a discount mortgage?
Okay, so discount, again, it's attached to something, but this time it's not the Bank of England base rate, right? A lot of people think discount is also, if the Bank of England base rate goes up, discount goes up, right? It's not what it is, right? Generally, discount is attached to the bank's rate, right? So for example, let's say X Bank, they're offering a mortgage at their standard rate is 5%, the standard variable rate, or SVR, we call it. So they say we will give you a discount on our standard variable rate. So that's why it's called a discounted mortgage. So if the discount is 3%, your standard variable rate is 5%, then you pay 2%, right? But tomorrow, if the standard variable rate goes up to say 5.5%, your interest rate will also go up by that 0.5%, which they increased it by. So which means, 2% will become 2.5%, right? So you get a 3% discount on the bank's rate. So that is what a discounted mortgage is, right? You'll have to sort of be aware how it works. Generally, discounted mortgages are, technically it's not connected to the Bank of England base rates, but most of the time I find when Bank of England increases their rate, the banks also increase their rate because they increase their standard variable rate. So invariably, you'll start paying extra interest, right? But it is not connected, right? So technically it's not connected, but I think there is some correlation between the two.
All right, thanks, Ifti. And then the last one, we've got variable or standard variable.
So that's actually the rate at which the bank lends you, right? So for example, if you go to a bank and say, I want a mortgage, that's the rate you get it, right? But what happens is a lot of people say, I want a deal. So I want a deal for 2 years, 3 years. So then bank strikes a deal saying, okay, we'll give you a deal for say 3%, but during that period, you have to be locked into us, right? So if you leave, you have to pay a penalty generally, right? So that's what it is. So standard variable is the rate at which they normally lend out. So most of the time we see standard variable rate, when somebody's deal finishes, right? So if the deal finishes and you don't do anything about it, you move to the standard variable rate, right? So that's kind of what happens. So that's why you have a standard variable rate. So that is a variable rate. Again, that is more or less connected to the Bank of England base rate. If the base rate changes, generally banks change the standard variable rate as well, right? So that's what I've seen in the past. So, but that is the rate at which the banks lend normally for people who don't have a deal, right? So that's kind of what it is, yeah.
Thanks, Ifti. And then just moving back to tracker rates, let's now talk about some of the advantages and disadvantages.
So the tracker, the main advantage with most of the trackers, right? Not everything, but most of it, right? Just be careful. Is the trackers are, they come without an early repayment charge. So for example, if I sign up for a tracker deal today, let's say I got 2%, right? Say it's 0.75 above Bank of England base rate. Fine. Tomorrow, if I feel the Bank of England is going to increase base rates, or I want to buy another house, I want to sell the house and I want to buy another house, then I can go to the bank and say, look, I don't need this deal anymore, I'm moving, right? So if I'm moving the mortgage or buying another house or breaking the mortgage, I don't pay an early repayment charge, right? So that is generally the main advantage of having a tracker mortgage.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
And if the tracker products, are they done for a certain amount of time? Like, is it a 2-year deal, a 5-year deal, but there's just no early repayment charges, or?
Yeah, so generally some trackers do have early repayment charge, don't get me wrong, but a lot of one of the main features of trackers offered by some of the bigger banks is that they don't have early repayment charge, right? So yeah, but generally that is also on a deal. So it's for a 2 years or a 5 years. Generally trackers, people prefer having it for shorter terms because they have a little bit more control over that. But still, it's generally for a term as well, right? So whenever you strike a deal is when you get these, right? So with the bank saying, okay, I want a 2-year deal or a 5-year deal. But, as we are talking about advantages, this is what we find as an advantage at the moment, right? I mean, this is information as of today, can change. But we are finding at the moment is that tracker deals are about 1% cheaper than the fixed deals, right? Now, obviously, there are things that you have to consider before signing up for a tracker deal, right? And that's kind of the disadvantage of this product, right? The advantage is maybe, at least for now, you might pay 1% less than what others are paying on a fixed rate mortgage, right? So that is kind of an advantage you have. But obviously, if you feel that rates are actually going to go up, especially if you're signing up for a deal which has no early repayment charge, a few months down the line, you can come out of it, right? So, that you do have the advantage, right? You may have to pay a product fee for fixing it thereafter, but still, you have that advantage. So, that's kind of a very flexible product, trackers, right? And, people are going more and more for those things nowadays because obviously for some people, I did a deal for somebody the other day. He was paying about 1.2% interest. The best cheapest deal was like a fixed deal was a 3.2%. That's a jump of 2%, right? So he's considering to go tracker, right? So that's kind of what it is, right? Because he feels like, okay, I'm happy to take a chance than committing myself to pay 2% extra, right? So we are seeing more and more people think like that, right? But so that's why these products have become popular, because for a long time, it was fixed or fixed. That's what people would go for, right? They wouldn't go for anything else, right? So yeah.
Thanks, Ifti. And then now let's maybe talk about some of the disadvantages of these tracker products, if there are any.
Yeah, obviously with the trackers, the biggest problem you have is you don't have control, right? If the Bank of England increases the base rate, your product goes up, right? The price goes up. So the monthly payment is going to go up. So you have no control over that, right? So that is the biggest disadvantage you have in tracker. So for example, if a client says, okay, I want a tracker mortgage, and then a month down the line, he realizes that the interest rates goes up 6 months down the line, and he wants to go for a fixed, fixed rates might have gone up by then, right? So, you might have to sign up for a more expensive fixed rate. But at the same time, you might have to pay a product fee for that product as well, because you would have already paid for the tracker, right? So you do have those disadvantages, right? Because it's not like the fixed fee, you don't know how much you'll pay. But for certain people, it works very well. If you're thinking of moving house in a year's time and you want a deal still, for people like that, it may work better than paying an early repayment charge, right? Because I've seen people pay 25,000 early repayment charge, right? It's not always you see that, but I have seen that, right? So, yeah.
What is the benefits of the discount mortgages?
The biggest benefit you find is it's a bit like a tracker. In many ways, it's a variable rate, right? So in many ways, it's like a tracker, but most of the time, the discounted ones, it does have an early repayment charge, right? So if it does have early repayment charge, unlike tracker where you don't have early repayment charge, if the interest rates are going up, if you come out, you'll still have to pay the penalty, right? But the biggest advantage we find, right, that's why this is becoming popular now. A lot of people are asking for discounted rates because they're happy to take a chance on the rate, right? Because they say, okay, fine, budgeting is fine, but at least I can benefit from it now until if the interest rate goes up in the next few months or whatever it is, right? So people are willing to take a chance on a discount. So that's the biggest advantage. Because currently we find discounted rates even a little cheaper than the tracker, right? Some of the deals we find is a little cheaper than tracker because again, I was looking for a deal for a client. The best workable discounted was 1.77, but whereas the tracker was something like 2.09, right? So there was a bit of a gap. So people are still happy to take that chance, right? So that is the advantage. Because at the moment, it seems that on the face of it, it seems cheaper, right? But obviously, we'll only know how successful they are after that term, like after looking at it over the 2 years, right? But at the face of it, at least it looks cheaper, right? So that is the biggest advantage you find with these discounted mortgages, yeah.
Thanks, Ifti. And then obviously, I think we touched on the disadvantages, but just to recap, what are the disadvantages of the discount mortgage?
The key one is obviously, the discounted has early repayment charge, right? So in case you want to break the mortgage, you're moving house, or for some other reason you have to sell the property or whatever it is, you will end up paying that penalty, right? So that is the disadvantage you have. And obviously, you don't have control over the rate, right? And it's not Bank of England who controls that; it's the bank who controls that as well, right? So it is ex-bank, right? And another thing we find with the discounted mortgages is that most of the time it's the smaller banks who provide discounted mortgages. They're not the main high street banks, right? So they work in different ways. They are generally small building societies. They're a little strict, right, in many ways, and they don't have the systems as well as advanced as some of the banks, right? So therefore, the applications can take a little longer, and it can be a little lengthy because they seem to ask more questions, right? So that can be a disadvantage if somebody is in a rush. Discounted may not, take you over the line at the right time, right? So that is a disadvantage you will have. Yeah.
All right, thanks, Ifti. Do you have any more advice for anyone watching this video who is deciding between all these different mortgages?
So for people who are looking for mortgages now, at the moment, obviously discounted mortgages, some of them sounds quite nice. It doesn't work for everybody, right? Likewise, trackers don't work for everybody, and likewise fixed mortgages. It works for certain people and it doesn't work for someone else, right? So there are some attractive deals out there, but the attractiveness sometimes comes with a catch, right? So if you're not sure, you probably want to speak to an advisor, right? Because sometimes I know people are tempted saying, I want to go for a discount because it is cheap, right? But discount may not work for you. Actually, tracker might be better for you, or a fix might be better for you. It's always best to get advice, right? Because I know there's so many things happening. Inflation's gone up. Obviously, the interest rate is also caused problems, and suddenly people have to pay £300-400 more than what they used to, and obviously they're not geared for that. So it's always best to get some advice on this area before you just rushing in to get a deal signed up, right? So please, if you're not sure, speak to an advisor. Obviously, we can help you, but there are the advisors out there. There are banks out there who can help you. But obviously, some of the banks have some, restrictions because they can only offer the products they do, right? So, for example, like I said, it's building societies who offer discounted rates. But, if you are after the discounted rate, you can't go to the high street and say, can I have a discounted rate mortgage? Right? That won't work, right? So there are those things. But, by and large, a lot of people can help you in this. So if you're not sure, please do get some advice because these are tricky times, right? So you probably want to get some good advice before you do this.
Yeah, thanks Ifti again for that. I just want to put a reminder out there that these points may or may not be applicable to everybody. So as Ifti said, if you're unsure if they're suitable for you, please do check with an advisor. And if you don't have an advisor, I will leave our WIS contact details below, as we're always more than happy to help. Another little reminder that as a mortgage is secured against your home or property, it might be repossessed if you don't keep up with the mortgage repayments. Thank you for joining us again today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.